Welcome back to the FMB podcast, where we discuss finance, money, and business in simple terms. I am Banjo Oluwasegun, and this is episode 3 of our Investing 101 series. Today, I'll be discussing how to invest in stock. Stock simply means equity, and when we talk about equity, it means owning an ownership in a company. It means you are entitled to the company's assets and profit. So that is what we are discussing today, and if that really interests you, make sure you watch this video to the end. Welcome back. On the first part of this video, I'll be talking about what are equities. And I have here that when you buy a stock, you are buying a share of ownership in a company. And what that means is that you can claim a part of the company's assets and profit. And there are two main ways that you can make money from buying a stock. Number one is capital gain, and the second way is dividend. Now, capital gain, when the stock price goes up and you sell for profit, that is capital gain. In simple terms, it means, let's say you buy the stock at $10 per unit, and after 1 month, the share price moves up to $20 per unit, and you sell for $20 per unit. So between that 1 month time frame, you have made a $10 profit. So that is capital gain. And the other part of making money in equity is dividend. And dividend is an annual payment that the company pays you at the end of every financial year. So if the company makes profit, they share the profits to their shareholders. So dividends, some companies share profits with investors as cash payment. So if you're investing in equity, you make money in two ways: capital gain and dividend. Now to the second part, we discuss types of stocks. So I need you to understand that we have different types of stocks, and you need to be sure of what your investment goals are before you can also choose your preference that really meets your investment goal. Number one on my list is common stock, and this is the most popular, this is the most simplest for you to start with if you are new to investing. And most stocks fall into this category. Shareholders can vote and can earn dividends. If the company is paying dividend and you have a common share, you are also entitled to dividend payments. And the second type is the preferred stock. So preferred stock offered a fixed dividend and you don't have voting rights. And theoretically, basically, the preferred shareholder, if the company is winding up, preferred shareholder gets back their money before common shareholder. So that's the basic difference between preferred shareholders and common shareholders. And third, I have here with me growth stock. And when we talk about growth stock, we are talking about companies that are expected to grow quickly. They really pay dividends because they invest their profits. And when you're thinking of growth stock, you think about tech startup. And more recently, we have AI companies, and these are growth stock because they have high growth prospects. And I also have value stocks. So value stocks are undervalued companies with strong fundamentals. And what that means is that these are companies that have potential of growing in the near future, or these are undervalued. They have more value. Their intrinsic value is more than what we can see in the share price. Let's say, for instance, a big company making big profit, but their share price is relatively low in the industry. So what that means is that the company has a very good potential of growing in value, but probably due to some issues, the company is undervalued at the moment. So you might be looking towards investing in undervalued stock. And the last one I have with me is blue chip stock. So blue chip stock are large, stable companies with a good track record of performance. So think about companies that have been performing, giving out dividends, making tremendous profits over the years. And an example is Apple, Nestle, or Dangote Cement. These are companies that have strong fundamentals and have been performing over the years. So I have discussed 4 types of stocks: common stocks, preferred stocks, growth stocks, value stocks, and blue chip stocks. So if you are picking your first stocks to invest in, you can ensure maybe have company in each of these categories, or you can start with growth stock, value stock, and blue chip stock. Common and preferred share has to do with the difference that I explained earlier with voting rights and no voting rights, and it indicates that the company is winding up. The preferred shareholders will get their money back before the common shareholders. Now, on this third part, I'll talk about how the stock market works. So, stocks are bought and sold on the exchange. For instance, in the United States, we have the New York Stock Exchange. In the UK, we have the London Stock Exchange. In Nigeria, we have Nigeria Exchange Group. Now, these are platforms where the companies goes to in terms of selling out their shares. Okay, and it's an exchange where buyers and sellers can meet to trade their shares. Somebody willing to sell their shares, somebody willing to buy up the shares. And you have to know that the price changes constantly based on supply and demand in the market. So if we have more people selling the share than people who are willing to buy, then probably you see the share price going down. But if we have more people willing to buy and nobody to sell, you see the share price going up. So basically the principle of demand and supply. Now, when you invest in the stock market, you are trusting that the company you buy into is going to perform over time. For instance, if you are investing in GTB Bank, you are expecting the bank to perform in terms of its financials, make more profits, give out loan and make interest, and at the end of the year, distribute dividend and also increase its value to increase your capital gain. Remember, if you are investing in equity, you make money in two ways: equity and dividend payment. Now, how can you invest? You can invest through stockbrokers or app, and I'm going to demonstrate this to you after this introduction. You can have mutual fund and ETFs, and this is similar to what I discussed in our episode 2 when I was explaining bonds. So this is a group of stocks together. For instance, we have S&P 50, S&P 100, we have Vanguard. There are a lot of them, and this is a group of stocks together. So which better or less risky compared to buying an individual share? Because if let's say a group of 100 stocks has been combined into a single portfolio and 10 are underperforming and the remaining 20 or 30 are really performing, on average the index will still be okay because it's a group of stocks and not just an individual stock. And also we have robo-advisor here, and these are, like I mentioned, automated system that gives recommendation of stocks to buy and share to you, and you have to pay for subscription. And lastly, we have employer-sponsored retirement plan. So if you work for companies that are listed, some of them give out their share as form of compensation and also to build your retirement plan. On the first part of this video, I'm going to be discussing the risk and reward of investing in equity. Just like every other investment option, I told you, if you are starting your investing journey, always think about the risk and the reward. Now, stocks offer high growth potential, but also come with higher risk. And like I said, stocks has potential of giving you a very high return if you are in the right industry or you pick the right stock. It might not be that you are the best analyst, you might not be the best investment analyst in the world, but sometimes you just get lucky and pick one stock that really performed well, and you have your capital gain. And sometimes it might be otherwise, the company will underperform and you see your investment going down. So now we talk about the advantages and the disadvantages. So the first one I have here is potential for high return. So I've discussed this over time that the stock market has potential to give you higher return relative to other investment options. And liquidity. You can buy and sell stock easily because a lot of people are investing, a lot of people are selling their investment. And lastly, ownership in real business. And this is one of the key points for you to know, because you are investing in a real business, not a Ponzi scheme kind of investment. You are investing in a company that exists, some are even in existence even before you are born. You have companies of 100 years, 120 years, and they are still performing in the industry. Okay, and read somewhere online that if you buy Apple, invest in Apple. So if you are somebody that really loves Apple products, you have Apple PC, you have Apple tablets, you have Apple phone, and you use all the accessories, why don't you buy shares with Apple, so that if Apple is making money from sales and their profit is growing, you also benefit from the capital gain and you also benefit from dividend payment. So if you are eating McDonald's, buy McDonald's. Simple rule. Now, on the downside, we have price volatility, and it's important for you to know this. The stock market is highly volatile, subject to a lot of microeconomic fundamentals. what is happening in the industry. If there is war affects the stock market, the market is so volatile, and there's no guaranteed income. There are some companies that don't pay dividends, and you don't know how the company is going to perform in the following year. So it's all based on option forecasting. Check the trend, what has been happening in the industry, what do you expect to happen in the nearest future. And lastly, emotional investing. So people just get so emotional when they are dealing with investing. I urge you to stay consistent, try to see which market is convenient for you. You can start with like I mentioned, gold stock, start with blue chip stock. These companies that already have names, you can start with them, and then over time you can look for undervalued stocks and then start investing. So now I talk about the tips for investors. So if you have been investing or you are just starting your investing journey, these are some tips that I have for you. Start small and stay consistent. So from being consistent with your investment portfolio, you to learn more. You tend to learn new things. You learn more about the industry, you learn more about the business, and this helps you to build confidence in what you are doing. And research companies. Make sure you research the company you are investing to, understand what they do, how they make money, and their long-term potential. So don't be so emotional with your investment and just put money on any investment you see around, and diversify. So don't put all your money in one basket. Make sure you diversify across different industry. Like I mentioned earlier as well, you can invest in value companies, you can invest in growth companies, you can invest in blue chip companies, and across different industries, so that if one industry is affected, the other, your investment is safe there. And the last point here is think long term. So investing is a marathon, not a sprint, and you might just invest for the next 10 years. It all depends on your investment goal, which I discussed in our very first episode. So think long term. So now on this part, I'm going to take you to my mobile phone, and I will share with you how you can start up in buying shares and how you can go about it on your mobile phone. Now go with me. Now I'm going to show you how to invest in equities on your mobile phone using the Bamboo app and the Right Vest. Now let's get on the app. So if you open your Bamboo app, then you sign in as usual. So you will see all asset offering. They offer US stocks and Nigerian. So these are the two you can invest, the two markets you can invest in on this app. So let's start with the US stocks. So if you click on US stocks, you will see stocks that are listed, a whole lot of them. So we have Apple, Amazon, Global X, a lot of them, right? So you determine the one you want to invest in based on your research. I'm just going to give you an example of Apple in this case. So if you click on Apple, you can see the current price is $212.1, which is approximately 330,000 naira. You can see all this information on the app, and if you want to buy, you just click buy. And one good thing about the Bamboo app is that you can see the analyst rating, and they are saying the current price is 212 and it is projected to go to 232 in the nearest future. So this is talking to you about capital gain. So you can buy it at 212 today, and in the nearest future the price is expected to go to 232. So that is more like a projection. It might get there, it might be more than 232, it might not even get there at all, and the market will continue to go down. Okay, but let's do a bit of historical performance of Apple. So I'll just click on 5 years to see how this stocks has been performing over the years. And just to explain capital gain again, if you can see February 12, 2021, okay, this is $135. Okay, so let's as you bought this time, and since 2021 till the current price today, that will be around 36% interest. Okay, and you can see the market keep fluctuating. The market even moved down to 141, then goes up to 195, 180, 190, 200, 219, and you can see the market has a peak on 28th of December 2024 at 254. Let's say this was when you bought these shares, you would have lost about $42 on the value of your share. So this is what I mean when I was explaining that the stock market is highly volatile. You know, the market in your favor, and you have a lot of capital gain, and sometimes it might go down and you will be losing on your capital. All in all, you should be sure that you will also get your dividend at the end of the year if the company is a dividend paying company. So regardless of what the capital gain is, you will get your dividend payment. So that is why you have to think long term if you are investing in equity. So from December 2024 to the current year price, you can see the market has dropped significantly, but all in all, you can see that the market is going up. And what this means is that the company is to the shareholder, and they have reason to still invest in Apple. I made a statement earlier that if you like Apple, if you buy Apple, then own Apple. buy Apple shares. All right, so I will also do an example with a Nigerian stock. So you can also click on Nigerian stock and you can see a lot of Nigerian companies. So if you're in Nigeria, you can also be familiar with some of these companies. We have Access Holdings, Airtel Africa, Boa Cement, Boa Food, Dam Cement, and all of this. So as you can see, the percentage changes. So what this means is that the market has dropped about 0.53% today and all of that. So I'm just going to so if you want to buy assets, for instance, you click on it and then you can click buy and then buy. Okay, let's look at 5 performance. As you can see, if you buy this market, if you buy Access old shares 24th of April 2024 at what's the price, 16 naira. Okay, the market was selling for 16 naira here, and you decided to sell February 7th 2025 when the market is at 16. Okay, so if you compare 16 naira per share about 28 naira per share, you can see you gain about 10 profit per share. So if you have like 1,000 shares, so you times 10 times 1,000 share, and that is your capital gain. Okay, so I'm going to give you an of fixing to see the performance of this company over. So currently, the share price of fixing has made about in less than 1 year. Okay, so if you check the date as of January 29, 2025, the share price is selling for 17.2 naira per share, and you can see the share price is currently at 44 naira per share. Okay, so if you have bought this share this year, you will have 30 naira on each of your shares. So if you have like 1,000 share, the same rule apply, 30 naira 1,000 share, and that will be your capital gain if you have bought fixing. So in this example that I've given you, you will have seen that, let's say you invested in fixing and someone else invested in Access Holdings. You will have seen that you will have made, even though you invested the same amount of money, you will have made more money than somebody that invested in Access Holdings. And there are some companies that might probably have negative return within the same period, and that is why I made mention that the stock market is highly volatile and also can make return compared to other form of investment. So I think I've been able to demonstrate to you the different ways you can buy these shares. So you can use the Bamboo app, or you can use the right verse. You just click buy and then you are able to buy the shares. Now, to sum it up, equity are one of the best tools for building long-term wealth, especially when you are investing smartly and stay informed. There are ways you can check about their financials on this app. Okay, there are other apps that you can use. I'm going to make another videos on how to make your investment research, but there are some few information about the company, you know what they do, and you can use that to take your decision. But however, we have investing.com, and this is an app where you have access to, you can see this, the US markets. You can come to any popular market at all and then search for the stocks you are looking to invest in, and you have more information. So if I click on, for instance, you can see the share price, you can see a lot of information about Microsoft. You can read the news on Microsoft, you can see their technicals, you can see the analysis, you can see historical data. So this is for you if you're an investment analyst, financial analyst, you know. But this app, right, but a novice and you're just starting out, the app is enough for you to start with.